Advanced strategies for commercial real estate financing. Diving into the complex world of commercial real estate financing in today's market means grappling with both opportunity and caution. With the Federal Reserve holding interest rates high for the foreseeable future, developers and investors are navigating a landscape where flexibility and proactive strategy are paramount. Commercial real estate's high-stakes nature demands not only resources but resilience and a keen understanding of market signals, trends, and shifts. For many, this is less about waiting for the ideal rate to hit and more about leveraging current rates to secure solid, if slower, gains on investments. In 2025, financing trends reveal a dynamic that prizes liquidity management above all else. Developers and investors must maintain accessible cash reserves, not only to adapt to the rising costs of borrowing but also to seize limited-time investment opportunities as they arise. For those with significant capital, this approach is a buffer against fluctuating rates, particularly as we see larger institutional investors adopting similar models to minimize risk and maintain a stable financial posture across portfolios. Meanwhile, the spotlight is on multifamily, industrial, and select retail sectors, which show relative resilience despite headwinds. Multifamily housing, for instance, remains in high demand due to persistent housing shortages. Even in a climate where borrowing costs are high, financing this type of asset can be viable given its strong rental income potential. Industrial properties, riding the e-commerce boom, are also appealing targets for financing due to sustained demand, especially for logistics and warehousing close to major cities. Investors should also keep an eye on the office sector, which has seen considerable volatility since the pandemic's onset. The hybrid work model has reshaped office real estate, leading to high vacancy rates and a consequent drop in demand, especially in urban centers. Financing options here are often harder to secure without additional assurances, as lenders are cautious, weighing the risk of vacancies against the building's potential for repurposing or redevelopment. The key for developers lies in creating spaces that cater to current and future workforce needs, with flexible, multifunctional layouts that could reduce the vacancy risk and attract a steady tenant base. In securing financing, one advanced tactic involves the use of bridge loans to cover property acquisition costs. This approach provides investors the flexibility to rehabilitate or reposition an asset, boosting its value before locking in longer-term financing. As offices and other properties are repurposed, bridge financing can act as an entry point, covering short-term costs with an eye on refinancing at a later, potentially more favorable, rate. Bridge financing isn't without risk, but it's a favored option for those aiming to capitalize on property value appreciation quickly. Another advanced financing approach includes securing mezzanine financing, a hybrid structure that blends debt and equity. This method gives lenders a stake in the property, so they share in both the risks and the rewards. For investors with lower cash reserves, mezzanine loans can help bridge the gap between what traditional loans cover and what's required for the project, albeit with slightly higher interest rates. As financing costs increase, mezzanine arrangements can offer creative workarounds that avoid traditional loan structures, giving developers greater flexibility without requiring them to surrender total control of the property. Amid rising delinquency rates, particularly in office and retail sectors, loan restructuring has become another critical strategy. In cases where property values have dropped or cash flows have diminished, renegotiating loan terms helps avoid defaults and potentially disastrous foreclosure proceedings. This may involve extended payment schedules, interest-only payments, or temporary forbearance. For asset owners, this approach preserves financial solvency while navigating temporary market volatility. A further complexity in today's financing landscape is environmental, social, and governance (ESG) requirements. Lenders increasingly expect borrowers to demonstrate ESG compliance, which can affect loan terms and approval processes. Properties that incorporate green building practices and social initiatives tend to attract more favorable rates. Consequently, savvy developers are embedding ESG criteria into their project plans not only to appeal to socially conscious investors but also to ensure access to preferential financing. To manage risk in a higher-for-longer rate environment, some investors are exploring treasury services to optimize cash flow, protecting their liquidity while waiting for strategic acquisition opportunities. Treasury management in real estate allows for better control over funds, ensuring that investors have a cushion against potential rate hikes or unexpected expenses. These services are especially useful for operators with significant property portfolios, where maintaining liquidity can be as valuable as owning high ROI properties. Alternative financing options are also growing in appeal, particularly through private debt funds and direct lending platforms. As traditional bank lending tightens, private funds, backed by institutional capital, are filling the gap, offering tailored loan products suited to specific property types or deal structures. These lenders are typically more willing to take calculated risks, giving borrowers access to higher loan-to-value ratios that may not be available through traditional banks. For those willing to invest in Class B or C properties, value-add strategies are gaining traction, as the opportunity to buy lower-priced properties and revitalize them can lead to significant returns. Investors are using a mix of debt financing and equity crowdfunding, where smaller investors can co-fund a project in exchange for equity shares. This approach spreads financial exposure while creating opportunities for smaller stakeholders in a traditionally capital-intensive market. As the financing environment for commercial real estate grows more complex, creativity, flexibility, and strategic partnerships are the watchwords. The fundamentals of each deal, from property quality to cash flow expectations, weigh heavily on financing options. But for those with the foresight to read between the lines of market trends and leverage every available tool, commercial real estate remains an attractive, albeit challenging, domain. Call 888-653-0124 today or click the link in the description to learn more and share your success story.